Good day. As always, we had a very interesting quarter and obviously a very interesting year in the fixed income markets in South Africa and globally. I think it's quite important to understand that bond yields were mainly driven over the last year by what happened in global markets and not just in South Africa, but especially over the last quarter. I think it's quite important to understand that the US base rates in the world changed significantly. If you think that at the end of 2020, the US 10-year was around 1%. Now it's trading probably in excess of 1.7%. So we've seen a massive derating in US bond yields, which obviously had a big effect on the South African bond market. In our own market, we've obviously had a few drivers. I think the most important one was obviously the budget, where we saw the Minister of Finance come out and say, look, we have to arrest the debt to GDP ratio and we have to borrow a lot less, and the borrowing requirement in the bond market is now a lot less. Our weekly auctions are probably less by about 2 billion, which means that the pressure from bond yields are off a little bit. But what we have seen is that because the US yields have moved that high and other developed market yields, our own 10-year bond yield has moved from probably around 8.4% to around 9.5%. But what it says to us is that a lot of negative news still remains in the South African bond market. We still feel that South African bonds are cheap and they are a good buying opportunity. So if we look at returns, I mean, investors were handsomely rewarded for staying in bonds over the last year. I mean, nominal bonds gave you a return of around 17%. Inflation bonds gave you a return of about 17% as well. You probably had around 5.5% out of cash, and you probably had around 67% out of credit markets. Going forward, we still believe that there's good value in South African bond markets. And we would actually tell our clients to be invested in more than one asset class. We would prefer if our investors are invested in nominal as well as inflation bonds, not just in one asset class, but also not just sitting cash because there's a fear trade on. Cash, unfortunately, this year will give you very low returns. So from a returns perspective over the next year, we think that yes, cash will give you around 4.5%. Credit will probably give you around 5.5%. But then the interesting asset classes would be inflation bonds, where we think that returns anywhere from 7 to 9% is absolutely achievable without a stretch, and around nominal bonds, which would probably also be around 7.5 to 8% returns, which we think that, you know, when inflation is around 4 and you can get 3.5 to 4% real returns from the South African bond market, they look attractive on a risk-adjusted basis and on a straight line basis. And we would actively encourage our investors to be invested in South African bonds. Be more circumspect around credit. We are a lot more circumspect around credit. We think there are risks of defaults in the corporate markets. So we like markets like that because it means we can go and look for one or two gems between all the rocks. But yes, we're still bullish on nominal and inflation bonds. And we say to investors, we think there's good returns for them over the next quarter and next year in it. Thank you.